been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is President and CEO of Anagnost Investment Group, Dick Anagnost. Now, Dick has been recognized as a transformational leader and a dynamic force in the ongoing renaissance of Manchester, New Hampshire, as he continues on his mission to revitalize the state's largest city and change its skyline. Dick has more than 40 years of demonstrated achievements in industrial, commercial, residential, and land development. Through a public-private partnership with the city, he spearheaded the conversion of more than 40 significant properties in the downtown and renowned Millyard districts. Now, in today's discussion with Dick, we're going to cover a lot of different topics here, but more importantly, we're going to start from the beginning. We're going to back up, and for those that maybe didn't listen to my first episode with Dick that we did about 5 years ago, we're going to learn how Dick got his start as a limousine owner-operator before moving into the commercial real estate world. And then we're going to talk about all the incredible achievements that he's done since that point in time, which the list is very, very long. So I'm excited to have Dick back here on the show. But before we introduce him here, just have a few quick housekeeping items to run through. First and foremost, our third mobile home park investment fund is live. We launched it a few months back. If you have an interest in getting into this space and partnering with a team that has been doing it for nearly a decade, we've got a tried and true track record and are looking for opportunities to partner with accredited investors that want to deploy capital into the space. You can go over to investwithsunrise.com to learn more about that partnership opportunity. Again, that's investwithsunrise.com. And there you can access our most recent webinar, our PPM, offering docs, what have you, and learn just what it is we do and again, how you can team up with us. Again, that's investwithsunrise.com. Moving on here, if you love what we're doing at the Real Estate Investing for Cash Flow podcast, please take a moment to subscribe if you haven't done so already. That way you'll get notified when all new episodes go live. In addition to that, if you feel like we add value to you and your business on a regular basis, please take a moment to leave a rating and review. It really helps us attract great guests such as Dick to the show. And then lastly here, I want to remind you of the 30-minute phone call I offer each and every Friday afternoon. Been doing this now for going on 7 years. This is where I set aside 2 or 3 30-minute time slots to connect with you, the listener. I've been doing it now again since I started the show, and there's no ulterior motives here. I promise you, I won't try to sell you anything. I'll just look forward to having a good conversation with you and just my way of connecting with others that share a similar passion for real estate investing. And it doesn't matter if you're just brand new getting started or if you're a seasoned pro. I'd love the opportunity to meet with you. You can go to my website, kevinbupp.com, to schedule that call. Now, guys, let's get on to the part of the show that you've been waiting for, which is our interview with Dick Anagnost. Dick, how you doing today, buddy?
Very good, Kevin. Good to see you again.
Yeah, I'm excited to have you back. As I mentioned to Dick, I assumed in my mind, my pea brain of mine, that it was like 2.5 years since he was on last. And I reflected back. I looked at the episode number, and it was way back, like episode number 111, which was going on 5 years ago. And so time flies. I've got an extra kid since that point in time, and so my life looks very different. I got a lot more gray hairs. Dick, you still look really good though. You're holding it together pretty well.
I'm not sure about that, Kevin. These podcasts aren't as clear as they need to be to show the number of gray hairs in my head. So,
yeah, good deal. Either way, we're here. We're both here. It looks like you're very healthy. I am as well, and we're gonna have a fun conversation today. So, what I love to do, Dick, for those that might not have heard you on other shows or heard the previous show that we did together, give you a few minutes and have you kind of fill in the blanks about your background, your past, and ultimately how you found your way into the commercial real estate space.
Oh, my entrance into real estate was really accidental because you know the story, Kevin. So I opened up the first limousine company in New Hampshire roughly in the late 70s. We ended up being licensed to the State Public Utilities Commission, which forced us into the real estate market for a couple of things. So the first thing we needed to do was rent an office, and because we needed a public place where the public could come in and transact business with us, was one of the regulations of our licenses. So we found a small office through a real estate broker sign in downtown Manchester on an upper floor of Elm Street, about the size of the studio that you're in, Kevin. And I wouldn't even say the studio, but the size of the booth that holds your microphone. And we signed a lease with a landlord. And it took about 15 minutes for the real estate broker to show me the space. And I signed what they call a gross lease. For all you real estate practitioners out there, didn't know what that was at the time either, but I knew that everything was included and I only needed to make one payment, and that's what we were looking for. So we ended up going to a closing with a landlord where I produced a security deposit check and the first month's rent check, and the landlord signed over that check to the real estate broker. And as we were leaving the premises, I said to that real estate broker, geez, you have my check. Why do you have my check? He says, that's my commission. That's how I get paid. I said, you got my check for showing me a closet and it took 10 minutes of your time to do so? And he said, yeah. And I said, how do you become a real estate broker? And he told me how to get licensed through the state. And 6 months later, I was a real estate broker. The next big lesson came when we needed to rent a garage for our vehicle so that it could, we had started out with one limousine. We just needed to garage it, but we needed a place to work on it, to clean it and make sure it was good between runs and those kinds of things. So we needed a covered garage. Again, not having much money, we found a garage in the east side of downtown, and it wasn't the most attractive place that you could come across, but it was within our budget. And here I signed something called a triple net lease. Again, at the time, I didn't know what a triple net lease was, but if the guy was willing to lease it to us for us to go to work, we decided to go ahead and do it. And here's where my next two lessons came in. So the garage was pretty decrepit, and it was, your quintessential, you could tan inside the building because the roof had a hole so big, and you turned on the light and it looked like Frankenstein's movie where the light would zap on and off like it was zapping flies in your backyard. And then it would come on, and the plumbing barely worked. I mean, you could potentially not overflow it every third time. But it was home, and we started to utilize it. But eventually, as we gained more space and got more cars and more people, it became totally unusable. So I went to the landlord and I said, well, this is your building. We can't stay here under the circumstances. We need you to fix these things. And he showed me in a triple net lease how it's the tenant's responsibility to maintain the premises. And he explained to me that I had to go take care of these problems on my own. I said, well, we're not roofers, we're not plumbers, we're not electricians, we're kind of handy guys, but we don't know how to do these things. So he handed me a business card. It was his brother-in-law, and he was a general contractor. And he came to my little office, which is the size of your studio, and he sat at my desk and he used my yellow pages. And he called a roofer, a plumber, an electrician, and they all came over and did their part on the building to make it safe and usable for us. Then he presented me with a bill. And at the bottom of the bill, it had the attachments from the plumber, the electrician, and the roofer, and it was an addition of 20% to the bill. So not having a lot of money, I questioned, well, why is the bill marked up 20%? He told me that's his fee and that's how he gets paid. Okay, so I asked him how you became a general contractor, and 6 months later, I was a general contractor. But then the real lesson came that pushed me into real estate, Kevin. And that was, we had signed a 2-year lease, and it was in year 2 that we did all of the improvements to the property. And, my guys were pretty handy. They painted it. They replaced the windows. I mean, it turned out to be a really nice space. We redid the floor so that we could work in the place. And I went to see the landlord about extending the lease. He put in a call to me and said, we need to have a meeting. I went and sat down with him, and he told me that he was doubling our rent. And I said, well, how can you double our rent? We paid you on time every month, and we just did all these improvements to your building. And he says, yeah, under triple net lease, you were required to do those build improvements, and you made it so nice, I can get double the amount of money for it now if you move out. So from that point forward, Kevin, I owned every building that every one of my businesses ever been in, and essentially went into the rental of property and the development of property for others. And that's how it all got started.
Well, that's an exciting story. I'm sure there's a lot more to unpack there, right, over that time frame. However, it's interesting how getting pushed into a corner ultimately really, writes the future or the your career path that a lot of us take in our lives, right? And it's kind of hard to see that next door until you open the first one, but ultimately that's what happened. And look where we're at today. We're 40 plus years later, and you've been involved in some incredible projects and just lots of recognition along the way, and so excited again to really dive into some of those items. But hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche, and that's the phenomenal niche of mobile home park investing. Now, for those that don't know, I've been a full-time real estate investor for more than 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in Growth and Income Fund 3. When you invest in our fund, you get immediate diversification into multiple deals we acquired off-market that are already performing and have built-in sweat equity. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please visit us at investwithsunrise.com and request access to the investor presentation. It's absolutely free, and you'll get instant access to review the off-market deals that we've already purchased that you can co-own with our team. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-227-4359, and our investor relations team will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule the call. Let's jump on the phone. And with that, guys, I'd like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. As far as, your, limousine business, from that point forward, you bought all your own buildings, and so I guess you could say you were in the real estate business. But you're buying the roof that was over the head of your cars and your other business, what have you. But when did the transition really take place, where you recognized a bigger opportunity to get into the development side of the business? I mean, when did that happen? When did you step out of the limousine business and truly get into real estate full time?
Well, we ran the limousine business for about 6 years until deregulation came when we sold it. And when we sold it, we didn't divest of the real estate. We kept it and rented it to them, and they became our tenant. And we had actually, my family, my company had grown when we opened the real estate brokerage. It was literally 6 months after opening the limousine company. So we started selling for others. Within a year after that, because of the deal with the landlord, we started buying properties. And when we bought them, we were typically buying low and renovating and then leasing out. So our first step into the business was through buying essentially rundown properties, renovating them, and then putting them back out for lease at higher rates, which played right into your show, Kevin, where cash flow started to flow. And as cash flow began flowing off the real estate, we kept reinvesting it in the company by buying and developing more properties. And then we had our first opportunity to build a residential project where we began to develop it from the ground up, actually acquiring the land and then going through the entitlement process. And that was probably 5 or 6 years after the first purchase of the limousine company. And then now we are 95% development, and we're vertically integrated, which means we have a development company that acquires the land and produces its entitlements, then hands it off to our finance company, which then puts together the financing package. That company hands it off to our construction company, which then builds it out, which then hands it off to our brokerage and our leasing people, which leases it up, who then hand it off to the management team that manages it with the maintenance team underneath them. So we're essentially cradle to grave in the real estate business from any kind of for any kind of project.
Got it.
And I can probably claim or not proudly claim, because most people have specialties, that we're kind of a jack of all trades. I've developed every kind of property you could imagine, and I've built everything except a hotel.
Well, that's probably in today's world, that's probably maybe a good thing that you don't own any hotels, at least at this point in time.
God bless me.
Oh, gosh. Yeah, that is the one asset class that I do not own either. And so, feel for those that out there that are listening that are in the hotel space. And however, I do think there might be opportunities in the hospitality space here in the coming year or two, as we see a lot of some of the distressed CMBS loans default. But again, I do not wish that on anybody, and feel for all those that are in that position right now. Stepping back a little bit, Dick, was there ever a point in time? I know that, when I got into the business, there was a gentleman by the name of David that really showed me the ropes. I mean, he introduced me to real estate. It was really what became my first mentor, right? I mean, I still made a lot of mistakes, but he helped me avoid a lot of them, right? And then I've had a lot of other mentors along the way. Was there anyone that really helped you learn the ropes early on? And if so, who was that individual, and how did they participate in your learning?
I wasn't that smart, Kevin. It actually happened the opposite way. There were no mentors. We were plugging along and doing the best we could, and we're all self-taught here. So, each mistake taught us not to make it again. And above all, we ran into more unscrupulous people who tried to rake us over the coals in the real estate business than we did mentors that tried to help us through it. So, if you ever wanted to use the old cliche, the school of hard knocks, that's how we have survived.
Got it. Talk to me about, I think of developers, and I'm not a developer. I've never developed anything in my life other than some expansion projects of already existing communities that we own, right? And so that's a very different animal. I do not consider myself a developer by any means. I feel that developers have this inherent ability to see what others can't see, right? They can envision what others would say might be impossible or isn't realistic or is a crazy idea. And is that a learned trait, or is that something that you're just born with?
I think it's a little bit of both. First, you have to be able to step out of the norm. I mean, a lot of people are known as real estate developers, but they're really not developers. What they are is they're following a mold or a trend that developers have set. For instance, multifamily housing developers. There's a lot of people out there building multifamily housing, but there aren't a lot of people out there that can take it from cradle to grave with the entitlements and develop it all the way through the process. It's usually someone is within the process. There's a developer that may have gotten the entitlements and the approvals. He may have sold it to a builder who built it, who may have sold it to an investor that then operates it. And that's more the norm in the business today than there is actual cradle to grave developers. A lot of us died off in 08 and 09 during the big crash because development is a very, very risky business. And unlike most cash flowing real estate where you come in and you buy a multifamily or you buy a Walgreens or you buy a commercial piece of property that has a tenant in it and you essentially put your back loan in place and you collect the rents and pay it. Development is extremely high risk because of exactly what you just said. If you don't have the vision and the vision isn't right and the project fails, you're out all of the money. Because all of the developers' money is put out first. It's put out to the engineers to get the entitlements. It's put out to the architects to develop the plans. It's put out in fees to the state. It's put out in impact fees. It's put out in all these different manners with little hope of return until the project is approved. And then even when it's approved, you still got to make sure that it's financially viable and that you can raise enough equity or you have enough equity to make the project work so it can be built out. And you really don't get a reward as a developer until the very end when it's either cash flowing or when you sell it. So it's a long process and it's a really high risk process.
Yeah. You mentioned a lot of the older, I guess long time cradle to grave developers, that truly take it A to Z. There's a big portion that died off in 08, 09 after the crash there. Well, talk to me about your business during that period. I mean, challenges that you guys went through, how you pushed through them. I mean, you talk about a smack in the face, but then an incredibly slow recovery phase thereafter. Did you guys have challenges during that period? If so, what were they and how'd you overcome them?
Actually, what I'm about to tell you is going to be opposite of what you think. So we doubled in size between 2009 and 2014. Okay, and the way we doubled in size was going into the recession, we had built our company on a strong foundation of sound real estate investment principles with strong tenant bases, and our diversity of product, meaning we owned everything from a dog grooming center to large multifamily projects. The diversity of our portfolio allowed us to weather it really well and weather it with a lot of cash flow because even though real estate was getting killed, there were a lot of businesses that were still doing well and they were still paying us rent and we were still getting cash flow off of those things. And the one thing we saw was, unfortunately, in adversity, there's opportunity. So we saw tons and tons of opportunity and said that the market can't stay like this. The fundamentals of the market will come back. They always do. And so we started buying things and building things at very low prices and reaped the benefit of it by doubling the size of the portfolio in about 4 to 5 years during that recession period. And we're pretty bold. I mean, developers are accustomed to taking risk, and I take most risk when the market is down. When the market's high, I don't have a lot of deals. That's why I build a pipeline when the market's down. Because as the market goes up, prices go up. And as prices go up, the margins become thinner for developers. So therefore, when the markets are really good, we kind of hold back and manage what we have and pick and choose projects. And when the market turns down, that's when we go into the market with a lot of strength. Given the adversity that we're facing in 2020 here, and for those that are listening, just give you some context, we're recording this on December 29th. You probably won't be listening to this until sometime late January, early February, but I'm pretty sure, very confident that we'll still be talking about the pandemic and we'll still be working through the challenges
of the pandemic and things that came as a result of it. And I know that you're in New Hampshire. Every state's kind of managed this crisis differently than the next. Some very extreme with shutdowns. Some states like Florida and Georgia and a few others that have been very lax with the shutdowns, and most businesses have been open, with the exception of still limited dining, and also hospitality is just getting kicked in the rear end. I think pretty much across the board. Do you see any New Hampshire specific, your market specific? Do you see any opportunities that will ultimately come as a result, maybe next year or the year thereafter, distressed opportunities as a result of the adversity that folks are facing here today?
Well, they've already begun, Kevin. Retail is one of them.
Okay.
I think that post-COVID, or even as we go through COVID to post-COVID, the strong markets are going to be multifamily, because everybody needs a place to live.
Mm-hmm.
And there's a huge demand, but the supply is down. Even in the residential market right here, right now, we have a supply-demand issue where there's huge demand for residential housing. The supply of people, even resales or new construction, has diminished, thereby driving up prices really significantly in the last year as a result of COVID. So I see that the residential market will be level. I see that the multifamily market will increase demand. I see that anything transportation, warehouse related, manufacturing related will be a huge in demand. Medical is still a product that's out there that's in high demand. But the office market and the retail market, in my opinion, are going to take a nosedive. The office market, because people have now learned to work remotely. The office market had been changing anyway. When I started in this business, if you had a full-time employee, you were figuring as a developer that for every employee, you were 150 to 200 square feet of space. That has diminished to 50 in 2000 at the beginning of 2020. So when you're figuring an FTE, you're figuring 50 square feet for that person. That's going to diminish even less, because some people can work remotely. Some people can work remotely part-time. There's going to be rotating shifts within offices. There's going to be shared spaces within offices. There's going to be all these unique improvements that come that essentially drive the occupancy cost of large office users way down, thereby them requiring a lot less space, which means space will open up. And as that space opens up, its price will come down. And it's going to be the repositioning of that space that's going to be an opportunity. I don't foresee that market being built, because I don't see a lot of demand for it when there's availability of space within the market that can be reconfigured. The opposite is true of warehousing. We don't have enough now, but the construction cost is so high you can't make the numbers work. I'm hoping as a result of COVID, the construction costs come down into reality and that market can expand with respect to build. The other market that's going to be an opportunity is your retail market. Large shopping malls are eventually going to go away, and some of them have already, and we've taken advantage of that. We've bought a couple of malls, and it's the adaptive reuse of those malls that's going to present its opportunity, because you're going to be able to buy them at a deep discount, because they're going to all be vacant, and they're going to have huge vacancies and inability to readapt those without the reinvestment of a lot of money. We've been pretty creative. You said something about developers have to have foresight. They do. They need to understand their marketplace. They need to understand what the demand is in their marketplace. And for instance, we just bought a 750,000 square foot shopping mall that had been completely vacated. And we've repositioned it with municipal office. We repositioned it with medical office. We repositioned it with religious occupants. We repositioned it with school occupants, educational. We've repositioned it with a mixture of residential on it as well. And those traffic generators have now driven retail back to us. Okay, this used to be a 750,000 square foot internal mall that had all retail in it. It's going to end up being more like 200,000 square feet of retail, and the rest of it other uses. Mm-hmm. We purchased another one recently that we're turning into self-storage. We've purchased another one recently that we're turning into a distribution center. I mean, they're all really well located. They all come with a ton of parking. They all come with great infrastructure. Okay, but the days of people walking to the mall and walking through and shopping in each store are pretty well numbered. Okay, between the online, between everybody that's in the current business rethinking their footprints, you're now going to, in the future, be able to go in, and they're going to be more showrooms than they are shopping centers. Okay, where you go in and you look at the product, you touch it, you feel it, you test it, and then you put your order in at the desk and it's delivered to your house the next day. Okay, so the footprints will shrink. As the footprints of the remaining existing retailers shrink, again, there's going to be a glut of space in the market, and it's how you redevelop that space that's going to be the opportunity.
Yeah, no, very, very exciting. Some of those projects you have working now. So the repositioning or adaptive reuse of the mall that you had mentioned, it was an interior corridor mall. Is that something that you your team has purchased this year during the pandemic, or is that a prior project? Really?
No, It was purchased at the beginning of the pandemic. Wow. Everything was shut down.
Wow. Okay.
And,
any challenges that have come about as a result of the pandemic? I mean, slowdowns, lower demand for space, per your pro forma, what have you? I mean, any major challenges that you faced?
Well, the major challenges have been physical in nature. A, social distancing. B, construction slowdown. C, shutdowns by government. D, one of the largest slowdowns is if you try to get through a building department right now with everybody working remotely, getting your plans approved, acquiring a building permit, and then getting inspections along the way have proven to be extremely trying and time consuming.
Mm-hmm. Yeah. Is that, I was having this conversation yesterday with a GC about that exact challenge. I've had this conversation many different times, and I almost feel that the COVID has become a ploy for, I don't want to work all that hard, but that's just my opinion. We'll leave it at that. I won't ask you to give me a response on that. So you've done some incredible historic projects in downtown Manchester, the Millyard, and I've never been to Manchester, so I'm not familiar with the city, what have you. But I believe if the number was 40 plus historic projects, and a lot of those done with a strategic partnership with the city of Manchester. What were some of those? I guess what did that strategic partnership look like, and then how has that played out over the years? Were there challenges with it? Could there have been a better way, or was that the ideal solution for this big project, or I guess multiple projects that you took on?
Well, there could always be a better way, and one of the largest problems with the public-private partnership was the public partnership's apprehension about what would happen. I mean, when we started our first project, I think it was in the late 80s, 88, 89, the main street in Manchester, New Hampshire was a dragway. Every store was boarded up. Every building was boarded up. So when we started our first one, the city put out an RFP to renovate a building where everybody wanted to tear it down and make a parking lot out of it. Great architecture. Bones were wonderful. I had multiple fires, needed a roof. I mean, it was a gut rehab, but what we did was we sat in a room together and made a determination as to how could the city cooperate? So the city can cooperate with zoning, the city can cooperate with approvals, but the city could also cooperate by getting us low interest financing through a number of channels that they had access to that we didn't. Okay, which naturally, as you know, the lower the cost of your money, the more likely you are to succeed, particularly when you're going to spend a lot of money, because it takes a lot of money to gut and rehab historically significant architectural buildings. So we found a number of programs through HUD, through the EDA, through there's an acronym or letters for every single one of these programs. I don't remember half of them any longer. But what we did is we ultimately layered 5 layers of financing, all that we jointly put together. And they expedited the approval process and what we were just talking about, above all, the inspection process. And by giving us those advantages, we were able to bring the first 40-some-odd-thousand foot building in Manchester to have been rehabbed in 5 decades, online in a very short period of time. And that that ability to do that began to attract attention. And the attention it attracted was our first anchor tenant was a major a regional restaurant chain, but something that had been extremely successful in the recent past. And they came and occupied the entire first floor. And then it was office from there above. And we were able to attract some pretty reasonable office tenants because we could offer a very reasonable rent, and we were the newest product in town. So that's how it started. And from there, we started looking at the exteriors, which we had rehabilitated historically, but we said, well, what other things we can do? Well, there was a national sidewalk program at the time that the city could get money. So we expanded the sidewalks. Why did we expand the sidewalks? So that we could put sidewalk dining outside in front of the restaurant. And, there was a lighting program that we tapped into, which we brought arches and lighting to downtown Manchester. And we did it on one corner, and we looked across the street and we said, well, that's not very good for the new tenants moving in, that's their view. So we went and bought the building in the next corner, and we did the same thing. And in that corner, we made it retail on the first floor, which we were able to attract. We made it an office on the second floor, which we were able to attract. But we went residential above that, which was a really good concept. One of the biggest challenges, though, that we met was trying to meet today's codes in buildings built in the late 1800s.
I was going to ask you about that, so I'm glad that you brought it up. Yeah, just really uncovering, all the skeletons that exist in those old historic buildings, and then ultimately bringing it up to code and be able to mitigate the risk associated with unknown costs that are going to come your way. So please tell me how you do that.
So the way that risk was mitigated was again by methods of funding, low interest money, CDBG money, which could go in at zero interest should we acquire one of those, and remains with the project till it's sold. No monthly maintenance of it to impact cash flows. So we mitigated our risk by having the city as our partner and their ability to tap into those programs that allowed us to progress forward. One of the largest impediments still currently today Manchester's now a very vibrant city. The downtown's no longer a dragway. I defy you to find a vacant space. And that goes for the first and the second floors. But the floors above that is still vacant, even after all this time. 30 years later, we still haven't been able to fill the upper floors because the amount of capital that it takes to bring, and the best thing that they could be used for, and I've brought this forth a number of times. One of them is we're a college town now with 5 colleges located here, and there's always a need for student housing. We could turn those upper floors into student housing, and what better use, because they would frequent all the businesses on the lower levels. They're small units by nature. They lend themselves well to the historical buildings where, you can't put in your 1,100 square foot 2 or 3 bedroom unit. So it meets it well, and you don't need a vehicle because everything's at your disposal. So that's a perfect use for those upper floors. Affordable housing is a good use for those upper floors. Again, it could easily be readapted, but without some sort of financial subsidy or low interest money to bring those upper floors into meet today's codes, without some creative interpretation of the code like we were interpreting at the time, it makes it cost prohibitive to do, and they'll remain vacant for a long time to come. And what I mean by creative interpretation, when we did the property at Amherst and Elm Street, it was probably the most significantly preserved building in all of downtown that showed 1800s architecture on the upper floors. Still had tin walls and tin ceilings and all of the woodwork and everything else. But in order to meet today's fire codes, they expected us to tear all that out, do double layer 5/8 fire rated in the corridors and all this kind of stuff. But we went to the fire department and ultimately to the fire marshal and showed them with high pressure sprinkler heads specifically placed. We could create a corridor, but it was a corridor of water versus a corridor of fire rated sheetrock. And they bought into it and allowed us. And that building still exists today as the premier example of 1800s architecture in the city. Another building where we went into was the Bond building. And in the front, there was architecturally significant staircases. They were made out of marble and granite. And and steel that had been all put together, and they were really, really pretty and really, really nice, but they didn't meet the width of the riser height to be able to get people out of the building to meet today's codes. So what we had the luxury of doing is the back of the building wasn't so nice. So what we did is we built a triple wide staircase in the back of the building and built our hallway so that you could get to that staircase going in two different directions, thereby allowing that staircase to serve as the main fire exit and allowed the architecturally significant front staircases to remain in place. So it was that kind of creative thinking that did a lot of the buildings that we were involved in. But, today it doesn't seem to be the same attraction because we have a vibrant downtown, and the motivation isn't there to make those kinds of concessions any longer.
Right. Understood. The majority of the projects that you've done over the years, Dick, do you typically hold them? I mean, are they in your portfolio today, or do you have a normal investment horizon and you exit out at some period of time?
No, there's still a lot of those. See, I fall in love with the buildings. They're like my children.
I'm sure.
Okay. There's so much work and effort and stuff to get them to the point where they're cash flowing and they're nice, that it's very, very difficult for me to part with them. So we still own a lot of them. But we have divested of a few. I mean, in the past few years, particularly, we've been offered significant prices over what we paid for them. It's hard to say no to a profit, Kevin, at certain periods, especially when you're looking to continue to grow and reinvest in other things. So, what I have found is the smaller projects have been sold through the years, and every 3 or 4 years or 5 years, we'll cull the portfolio and take out the smaller stuff, which is typically the most historical stuff that's been in the portfolio the longest, because as you grow, you'll find that it takes just as much effort to develop a 200-unit project as it does to develop a 10-unit project.
Right.
So, your effort grows as your effort increases, the size of your projects increase. So we've been blessed with the ability to liquidate when the market's very high. A lot of the smaller projects that we did, and we do it probably every 5 years.
Mm-hmm. Got it. No, we've talked about all these successful deals, the ones that have maybe not gone exactly as planned, but ultimately were deemed a success at the end of it all. Talk to me, Dick. Pick that one deal, the one that's kept you awake, way more than what you expected, gave you more gray hairs than what you ever anticipated, and just had so many more barriers than what you had planned for going into it. Tell me about that deal, what it was, what the challenges were, and ultimately what the outcome was.
Well, knock on wood, we haven't had many failures. Okay, we've had some that didn't yield as much profit as we anticipated that they might, but we've never had one that lost.
Okay.
But we did have one in the late 80s where we started it in 86, 87, and the market was really, really hot. It was a large multifamily project. We went into a town and we were going to put up 100 apartments, and we submitted our application, and we had a significant pushback from abutters and the town on the density of the project. But it was allowed by right, and we had all of the appropriate. We didn't need any waivers or variances or anything else, and we only followed their regulations. Well, about a third of the way through the process, they decided to change their regulations and gave us an approval that essentially cut 40% of our density out of the project, which no longer made it financially viable. So we had to go to Superior Court, and we won our case. Was ultimately appealed to the Supreme Court, and we won our case. And, that all sounds all well and good. But if you think of the time period between 80, and this took us approximately 5 years.
Wow.
So we started it in 87 and got it done at the end of 91. And if you look what happened in the market in 91, it tanked. The 5 major banks in New Hampshire got taken over by the FDIC, and every real estate went down 40 to 50% in value. So we won the battle, but lost the war.
Wow. That's, but you still, in the long run, you didn't lose on the entirety of the deal, correct?
Correct. We were ultimately able to sell it and get our money back out of it. We never developed it because we lost the market and there was no financing available.
Mm-hmm.
But we were ultimately able to sell it and at least break even, including the legal costs to take it to the Supreme Court.
Yeah. I was going to say, just the legal costs alone, I'm sure we're fairly significant. Well, Dick, this has been a lot of fun. I'm so glad that we had the opportunity to catch up. Always great information, always a great conversation chatting with you, and just glad to hear that you're doing incredibly well and business is still booming. And, what I'd love to ask of you before we wrap it up here for the day is, if you had just one final golden nugget of advice or wisdom that you could leave with our listeners here today that might inspire and motivate them as they progress in their very own real estate or development career, what would that last gold nugget be?
Well, most people jump on the bandwagon, Kevin, to invest in real estate when every one of their neighbors has, and they see that the market is hot and they need to go out and buy a multifamily that's overpriced because it can be overpriced because there's a lack of supply and a large demand because everybody's looking for it. That's the time not to do it.
Mm-hmm.
Okay. You want to get into real estate as a business, then you get into it and you get into it for the long haul. This isn't a kind of business that's going to yield you significant returns in a very short period of time. And if you want to look at it from that standpoint, you'll ultimately lose in the end. Okay. So real estate is a business that you do as a business. It's not a trend. Okay. That you want to jump on and get in and out of and attempt to make money that way. Because if you do, then you'll fail in the end.
Mm-hmm. No, that's fantastic advice. And, I can reflect back. So I've only been through one, recessionary period since I've been investing in real estate. And that was 2008. And that was about 7 years into my time as a full-time real estate investor. And it was a fairly substantial crash, as we all know. And, lots of challenges on our side and we pushed through, what have you. But, the one thing I recall back leading up to 2008 was the FOMO syndrome, the fear of missing out.
Yeah.
If I don't buy it today, I will be priced out of the market. And that, whether it was a residential house or a multifamily building or a retail property, it didn't matter. It was the FOMO syndrome. And I see that playing out again today. And what advice do you give somebody, and how could you, because right now we've been on such a long bull run, right? I mean, like, it's been going on, this recovery phase has been going on for an incredibly long time, and seemingly there is no end, even with the pandemic, right? Like, seemingly, at least maybe in the hospitality space, it's getting hurt and retail is getting hurt, but other than that, this pandemic, I know that the government's been propping things up, but it hasn't had that negative impact that everyone was anticipating back in March, April, and May, the beginning stages of this thing. And so for those that have that fear of missing out, I mean, what do you tell them? What, other than this is a long game, but what advice do you give that individual? If you've got him sitting next to you and he's a young, hungry guy and he wants to buy a multifamily because he's going to be priced out of it, what do you tell him?
Well, real estate's a commodity like anything else. It's definitely going to go up at some point, but it's also definitely going to come down at some point. Okay, governmental action, whatever it may be, a stock market bust, there's going to be an event that's going to drive real estate prices down.
Mm-hmm.
And I still believe that we haven't felt the ripples of the pandemic yet.
I agree.
Real estate. Okay, the ripples, the stone has gone into the water, but the ripples of the effect of that stone splash haven't been felt yet. So we're still in a period where evictions are stayed. We're still in a period where foreclosures are stayed. We're still in a period where banks are being free with their deference of payments and all kinds of things. Okay, there's a period this is going to continue on to, but there's ultimately going to be an end to it.
Mm-hmm.
Okay, and when the end comes, there's going to be a reckoning where the banks are either going to have to call the loans or they're going to have to take the write-downs out of capital, and it's going to impact their P&L and their balance sheet.
Mm-hmm.
When that begins to occur, real estate prices will come down again, okay, because demand will diminish and supply will increase. So you want to buy when the supply is high and the demand is low, and you want to sell when the demand is high and the supply is low.
Mm-hmm.
And I know that's somewhat of a cliche, but we're the living result of it. My first recession, I don't even want to date myself, was 81. Okay. Every recession that we've been through since, we've expanded during the recession and contracted during the rise of the values because we sell things at the height and thereby diminishing our portfolio, and we buy things at the low, thereby increasing the size of our portfolio. So we're kind of opposite of that. And I love the term that you just used, although I can't recollect it. Our philosophy is kind of opposite of, rising tide does float all boats.
Yeah.
But at some point, the boat goes over the dam because the tide has risen so high.
Yeah. Absolutely. My very first mentor, he always used to have the saying, you never lose by taking some money off the table. And that's we typically like to buy with the intent of holding long term, but we've sold a number of assets this year. Yeah. We sold a few last year, and we haven't bought as many as what we've sold. And that's very opposite of our business model, our long-term business model. But it's again, you never lose by taking some of the chips off the table. And that's not what I did prior to 2008, unfortunately, being green behind the ears and, just not knowing what I didn't know. I missed the timing aspect, as a lot of folks did, and didn't have the opportunity to immediately jump back in and take advantage of the stress that was in the marketplace, because some of that distress was my own and trying to figure that out and waddle through that mud. And I missed some incredible opportunities. So I've since then calmed my internal fear of missing out and have a much different vision and perspective than that of what I did leading to the last recessionary period. So we buy when it makes sense. We buy when it only makes sense that, we intend to hold that property for 10 plus years. It makes sense today. And there's enough margin of safety, we feel, that even in the event of a correction, or we might not be able to get rent increases for a 2 or 3 year span, or a debt, rates are going to go up, and we've got a capital event that's going to happen at year 5. We try to put it through various stress tests to, again, take stabs at what is the worst case scenario, and will this asset survive, and will we be able to ride that through the storm? So nothing's perfect, and there's surely not a perfect answer to our stress model, but we do our best to figure out which assets will be able to, again, weather that storm. But
that's the perfect way to approach it, Kevin. And I'll tell you a little secret. I've been predicting a real estate recession since 2017. So in 2017, we started to keep our powder dry and amass capital so that we can take advantage of the next turn. Well, I believe that the next turn is starting right now. And we've amassed a lot of capital over the last 5 years, waiting for this to come. So,
Well, I wish you the best, Dick. I really do. It's you and your team. I'm looking forward to hopefully maybe having you back on here in another year or two and talking about the expansion phase that you guys are going through as we enter into the next recessionary period. And again, never wish that period of time to come, because ultimately there's folks that feel pain and that the stress affects people in very negative ways. But it's part of the cycle. It's a cycle of life. And in any event, really appreciate you coming back on here. It's always fun to catch up with you, and wishing you well, you and your team well in 2021. And hopefully next time we talk, with the pandemic will at least be in the rearview mirror. It will still be in the history books, but it'll be in the rearview mirror, and we'll be moving forward with things. So, but again, thank you, Dick, for coming on. It's been a lot of fun having you.
Thanks for having me, Kevin. Happy New Year.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. We'll see you next Monday morning.